a few other things that are in play. This is a big week. Right now, we have employment numbers coming out. The JOLTS number did come out today. It was pretty weak. Pretty weak JOLTS report. The BLS will be out on Friday. You guys will, see that before this episode comes out. But we have a few other things that are starting to, oil and fear of inflation is only going to push rates so high. And I think we've seen the extent of that. The other factors, and we've talked about the employment numbers, they're being kind of, disregarded a little bit, but we know we have weak labor numbers. We had the Fed come out and kind of downplay the weak labor numbers, saying we don't have as much participation, so we don't need as many new jobs. I think that's a little bit of a cover there. But here's the other thing that will impact this is that as oil stays high, yes, it's inflationary, but it also can be detrimental to the overall economy. It can slow down the economy. And when that happens, interest rates usually get better. So we saw this, massive spike in oil, a big push up in interest rates. And then all of a sudden, we start seeing this decoupling from just where oil prices are and what the inflation fears are, and start going, well, what's deflationary is a slowdown in the overall economy. And so if we continue to see high oil prices, we could potentially see inflation get better. We could see the economy slow down, and the Fed's not going to like that either. That will exacerbate the labor issues that we have, et cetera. So this is a very dynamic situation, and it all kind of works together. We try to, even on this podcast, I try to simplify things in a way that we can, really wrap our head around them and give us good talking points to talk to our realtors or our clients about. But then there is additional layers of complexity, and that's kind of what this episode is about, is understanding some of those more complex issues that are driving the market. So it'll be interesting to see how the employment numbers, fare. Do we start seeing a slowdown in the overall economy because of oil prices? And then what exactly does happen to oil prices as this war hopefully comes to some sort of a conclusion, or at least a massive de-escalation? And then if we can get some stability back in the market, the good news is that mortgage interest rates could actually improve faster than anyone expected, which could create some pretty significant opportunity. All we need to see is consistency. We need the volatility to go away. We need the MBS price to improve and then stay there for a little bit of time. And then you'll see those improvements show up in your rate sheet, which I'm sure for all of you will be welcome news. Here's the deal though. Despite this spike in interest rates, I know mortgage applications are down a little bit year over year. But man, pipelines are still doing very well across the country. As you know, I work at a large independent mortgage company, and we're having near record volume months here as we wrap up the month of March. And I know it's not just us. I mean, the market is resolute despite this spike in interest rates. And if it does prove to be a short-term impact, then I think we could very well be off to the races for the rest of spring and into the summer market.